Blue Chip Bulletin. Financial market updates and insights.
So, PepsiCo just dropped its latest earnings report. And let me tell you, on the surface, the numbers look absolutely fantastic. But you know how it is with these big company reports. The headlines don't always give you the full picture. So today, we're going to dig in and see what's really going on inside PepsiCo's fourth quarter. All right, let's start with the big one, the number everyone's looking at, revenue. For the fourth quarter of 2025, PepsiCo raked in a staggering $29.34 billion. I mean, that is a massive figure. It really makes it seem like the snack and beverage giant is just firing on all cylinders. But hold on, let's add a little bit more context to that, because you can see here just how strong that performance was. Wall Street was expecting revenue to be around $28.97 billion, but nope, PepsiCo sailed right past that. They also thought earnings would be about $2.24 per share, and again, PepsiCo beat that too, coming in at $2.26. So by all initial accounts, this looks like a solid, clear win. Okay, so if revenue's up and they're crushing expectations, what's the big deal? Why are we even talking about this? Well, this is where it gets interesting, because there's a huge difference between how much money a company makes and how much stuff it actually sells. And that brings us to the real heart of the issue, what we're calling the hidden volume problem. You see, while PepsiCo was bringing in a lot more cash, a big reason for that was simply because prices were higher. But the actual number of chip bags and soda bottles flying off the shelves, well, that's a very different story. To really get this, we need to be crystal clear on one term: sales volume. Just think of it as the pure, raw number of products sold. It totally strips away the effect of price hikes or any discounts. It gives you the truest read on how much people are actually buying. It's really the best way to measure real, honest-to-goodness consumer demand. Now look at this. This is what's so fascinating. This tells the story of Pepsi's home turf, North America, their biggest and most important market. Sales volume for their food, think Doritos and Cheetos, it actually fell by 1%. And for their drinks, like Gatorade and Pepsi, it dropped by a pretty significant 4%. The bottom line here is really simple. In their biggest market, people are buying less of their stuff, period. And hey, you don't have to take my word for it. PepsiCo's own CEO, Ramon Laguarta, spelled it out perfectly. He said affordability is the biggest hurdle they're facing. Those price increases, while they definitely juice the revenue numbers, have started to push away everyday shoppers who are really feeling the squeeze on their wallets. Now, a slowdown like this in sales volume, it did not go unnoticed. When a company as massive as PepsiCo shows even a hint of weakness, it tends to attract a very specific kind of attention. And in this case, that attention came in the form of a super powerful activist investor who showed up ready to shake things up. So in late 2025, this major activist firm, Elliott Investment Management, announced that it had bought a $4 billion stake in PepsiCo. Now, they didn't just spend $4 billion to be a silent partner. No way. They bought in specifically to push for huge strategic changes to fix the exact problems we've been talking about. And you know what? PepsiCo listened. As part of an agreement with Elliott, the company committed to a major new game plan. It's got three main parts. First, tackle that affordability problem head-on by lowering snack prices. Second, simplify the business by cutting a full 20% of their product lineup in the U.S. And third, find ways to save money across the board to help pay for it all. So, with that little nudge from Wall Street, PepsiCo has rolled out this big, comprehensive new plan. And this isn't just about tweaking a few prices here and there. No, this is a fundamental shift in their whole strategy, and it's all designed to win back the customers they've started to lose. So let's break down exactly what this is going to look like for you and me. First, you're going to see price cuts on some of the biggest brands out there. We're talking Doritos, Lay's, and Tostitos. Second, that 20% products cut, that means getting rid of some of the niche flavors to really focus on the best sellers. And third, they're giving some flagship brands like Quaker and Gatorade a makeover. Simpler ingredients, new packaging, the whole shebang, just to boost their appeal. So, how's this new plan landing? Well, the early signs are actually really positive. The retailers, the grocery stores and convenience stores that actually sell all this stuff, they've apparently reacted with a ton of enthusiasm. In fact, PepsiCo is now expecting a double-digit increase in shelf space with its top customers. That means their products are about to get even more visible when you go shopping. So, that's the plan. That's the big move. But what does it all mean for the year ahead?
Let's take a quick look at what the company itself is forecasting for 2026 as it navigates this massive strategic pivot.
All right, so the company is projecting organic revenue growth to be somewhere between 2 and 4%. Now, that's a bit more modest than what they've seen in the past, but that makes total sense, right? Lower prices mean a little less revenue for each item sold. But, and this is key, they expect their core earnings per share to grow by a much healthier 4 to 6%. That suggests they're pretty confident their cost-cutting measures are going to work. And that brings us right back around to the final multi-billion-dollar question. After all the financial jargon, the activist investors, and the big corporate strategy, it really all boils down to this one simple thing. Will making a bag of Doritos a little bit cheaper be enough to get people to start buying more of them again? That, right there, is the big question for PepsiCo in 2026.